Welcome back to Investing 4.0, Visionary Investing in Future Trends. Now, last time we took a look at Alibaba's history, the business model, and finished with an outlook on the cloud business and recent developments. Now, today in the second part of the analysis, we will start with the numbers, which is a general financial overview, including the discounted cash flow model, and compare it to how actually institutional investors evaluate the company as well. And of course, we will finish it with a summary and my personal opinion. Before we actually start, as always, this is no financial or investing advice. Always do your own research, as this is just my opinion. And another disclaimer, I currently hold 23 shares of Alibaba, so be aware that I might be biased in my assessment. But now let's begin. All right, let's start with the basics. Alibaba's fiscal year ends in March each year, which means that we do not have the fully finished report for the year yet, but we'll work with what we got and use some estimates and assumptions. The current stock price is around $260 or 22 euros. And with over 700 billion in market cap, Alibaba is one of the 5 most valuable companies and currently on place 5 right after Microsoft, Apple, Amazon, and Alphabet, which in my opinion is quite impressive. Now, these numbers here are not updated actually, and we know that Alibaba's share price dropped a little bit in the month of November, but they should still be on place 5. The last full fiscal year report from 2020, which actually means March 2019 to March 2020 and not the end of 2020, which actually was a little bit confusing for me in the beginning, is showing overall growth for Alibaba. The revenue jumped by 35% from 2019 to 2020 and might probably have been even higher if we would have not had the global pandemic, obviously like any other company. China was in crisis mode as of basically November 2019, so the last quarter of that year was impacted quite negatively. However, I see it very positively that Alibaba managed to increase the overall income about 60%, considering that their investments into the cloud business required a lot of money, and the EBITDA with a solid 27% also makes each investor's heart beat a little faster, at least mine. Taking a look at the revenue charts, we could see the beginning of a potential exponential curve that is at its very beginning, as mentioned. Considering that the Chinese population is getting wealthier and wealthier and that the overall domestic market is growing in China, I am very confident that Alibaba right now is at the top of the food chain and is in a very comfortable environment and situation. So let's take a look at the latest earnings report for Q3, and that is from November 5th. You already know the top part of this chart from the last video, so if you haven't seen the last video, check it out because there I'll explain the different websites and the business models and what they are responsible for. So before looking at the numbers, have in mind that these numbers actually do not include the earnings from the Singles Day that was on November 11th. Alibaba achieved to grow the core business, which is responsible for almost 85% of the revenue, by 29% and could keep the EBITDA constant with 35% for this business or core business and 27% for the overall business, which was the same during the last year. The cloud business with Aliyun grew by 60%, so it's good to see that those investments are actually paying off. Still, Alibaba is losing money with this business area, but we have to consider that the investments will be depreciated over the next years and will actually kick in a few years. So that is still a comparatively small segment, which in the future will generate profits, hopefully. And right now it's responsible for 10% of the revenue. The digital media and entertainment segment only grew about 8%, but is also responsible for only 5% of the revenue and currently has minus 9% EBIT margin, so they're losing money with this business as well. Some of the websites, in my opinion, are actually growing, for example, the streaming business, but I think that in Alibaba's case, it's some kind of self-cannibalization, as the streaming sites will, in my opinion, steal some of the viewers from the classical sites like Youku. And Youku is basically the Chinese version of YouTube. So people will switch from those to streaming a little bit more. That's my prediction. So I don't assume a big change here for the next year or for the next quarter. The other innovation initiatives obviously are not profitable yet, and we will see if and when they will actually generate profits, but it's high investments here and we have to wait for it. As mentioned, only a few days after the Q3 report was published, one of the most important days, the single day happened and generated almost 500 billion Chinese yuan in GMV, and this was a little bit less than expected, but still a major success. Comparing it to the 2020 report, like overall, this one single day generated about 7.5% of the overall GMV. So the numbers so far look quite promising, and Alibaba is continuing its growth without any major distractions. To calculate a fair stock price, I used again the discounted cash flow model that you already know from the Tencent analysis. Now for this, I'm using the numbers that Alibaba actually providing us, and we'll take the revenue and deduct the costs, the R&D expenses, sales and marketing expenses, and general administration expenses, as well as the amortization and the goodwill. As always, I'm taking a rather conservative, but this time a little bit more realistic approach. And if the numbers still look good, this is even better for us in our situation. My assumptions are the following. I expect a revenue growth of 35% for the next 5 years, and then I think that it will slow down to 15% and finally 10% at year 11 and the following years. Again, a little bit more conservative, but probably realistic. For costs of goods sold, I estimate about 50%. This is likely to fall long term, but again, let's stay conservative for now. I'll show you what happens if we actually adjust this just by 5% after 5 years, I think, and to see if actually this has a big impact. The R&D expenses are usually a fixed number of revenue, and I'm using a little higher number than the last years here, again with 13%. For selling, general administration, and administrative costs, I calculate 17% for the next 5 years and then 15% afterwards. And for amortization and goodwill, they are kind of fixed, so we go with 3%. The discounting factor is an average from different websites like GuruFocus, Market Screener, and Finbox with 12%. So again, somewhere in the middle. We're going with 25 years here because basically with a discounting factor of more than 5%, anything that'll happen after 25 years won't have any impact. So we're just cutting it off after 25 years. And I think that's more than enough for the prediction. Now, with the current share price of $260, the fair share price still has 23% growth potential, to about $320 here. Again, these are, in my opinion, conservative but realistic assumptions. Let's see what would actually change if we would assume that the cost of goods would fall by only 5% after 5 years. And we see what happens. The fair evaluation would actually be $393 or plus of 51%. Yes, we see that a small change has a big impact here, but again, we need to play around with some of those numbers and see if it makes a big difference. But what do the actual institutional investors say? They do estimate 580% plus within the next 12 months in the low scenario and a whooping 890% in the high scenario. So I think everybody is on a strong buy recommendation right now. In my opinion, this is just another case that shows that you should always do your own research and never, and I really repeat, never listen to institutional investors or analysts. You should also not listen to me. I mean, I am sharing my assumptions here, and they're just basic. There are obviously more numbers and you could do way more detail, but in my opinion, these are the ones that matter most. And you should always do your own research and invest on your own decision. But I mean, I won't complain if their assumptions are actually right, because my 23 shares would actually be worth more than $50,000 in the median scenario, not even the high scenario. But hey, if they're that hyped, we should actually ask them why they're not putting 100% of their money into Alibaba if it's looking that good, right? But hey, let's not listen to the hype here that is spread by the institutional investors or by other YouTubers that would basically, in my opinion, say anything for clicks. This is a realistic scenario, in my opinion, and yes, it's still very positive. And if it's even better, perfect. Now, instead, let's have a quick look now at the risk as well to see if there are any major red flags that we should consider and should be aware of. This is not going to be super detailed, but just a major check if there are any big red flags. For this, I'll take a look at the 3 following categories: political risks, market risks, and also the stock market risk. Now, for political risks, we currently have the risk of this regulation that was announced which is also mentioned, and yeah, I quickly explained it in the last video. And I believe that the risk is medium and that Alibaba will not be affected too negatively by that. A big shout out to Metalolilol at this point. He shared some great research in the comments on the last video regarding the impact of the cancelled Ant Financial IPO. If you want to get a better understanding of the impact on the fintech segment, then please press pause and read the comments from Metalolilol, or even better, go to the first part of this analysis, so the previous video, and give him a thumbs up for this comment. I think, yeah, we both share our opinion of this under this comment as well, and I'm also curious to see yours, but please give him a thumbs up for this comment. I really like to see this. Overall, I would assess the political risk as medium, as mentioned. And yeah, as mentioned, the state has way more influence in China on companies, as we can see with the Ant Financial interference. However, I want to mention that this could also happen in other countries. And yeah, even in the US, Trump used his influence and had a big part on the automotive industry, for example, with his tariffs, or on the semiconductor business with the run for 5G and the US-Chinese trade war by forbidding to do business with companies like Huawei. I personally was affected by this in the US, as I was invested in Xilinx or Stillings, or however you want to call it. I say Xilinx. And I lost 30% of my gains just because of this one political decision here. And as always, there is some risk. And yeah, tell me a place where there is none, but I don't think that China is specifically, let's say, higher. And as just mentioned, we could see political impact on companies in the US as well in the recent years. Now, let's take a look at the market risks. And as mentioned, the Chinese population is getting wealthier and wealthier, and the domestic market is growing, which leads to a good environment for Alibaba. Obviously, Alibaba's growth is directly affected by the Chinese overall growth. And if we see an impact here, it will directly be reflected in Alibaba's business. Now, last but not least, let's talk about the company here, or specifically the stock market and where it's traded. Currently, you can buy Alibaba shares on the New York Stock Exchange as ADR or on the Hong Kong Stock Exchange. Whereas the ADR, which stands for American Depository Receipt, is just the right to buy a stock instead of owning the stock itself. It basically is just some kind of virtual representation, but not the real deal. Now, why is Alibaba doing this? There's one simple reason. China simply does not allow foreigners to own shares of companies within specific industries, and in this case, the internet companies like Alibaba or also Baidu fall under that category. So you might ask yourself now if there's any risk with this, or what you should do if you don't have access to the Hong Kong Stock Exchange. I actually have the following two arguments that support the ADR over the actual stock. And the first one is liquidity. The daily trading volume on the New York Stock Exchange is actually way higher, and that has a positive impact on the price range, or on the spread, so the margin that you pay between buying and selling price, and that allows you to buy or sell basically within seconds. So that's basically liquidity and a little bit safety here. And the second reason that I have is the legal security. Now, US listed companies, and they can be from anywhere in the world, in this case it's a Chinese company that is listed in the US, they have to follow very strict regulations considering the accounting rules. So whenever you're listed on the New York Stock Exchange, you have to stick to those rules. So I guess that there's actually a little bit more security and safety on this side due to the accounting standards. So after looking at the history, the business model, the recent developments, and now today the numbers and the risks, let me share my final opinion on Alibaba. According to the DCF model, with my assumptions that are, in my opinion, realistic but conservative, and it's also backed by the institutional investors, Alibaba is a cheap buy right now and has a lot of growth ahead of it. It has a local dominance in China and is also active on the global market, which is a good additional diversification. According to the Peter Lynch model that I really like, Alibaba is a fast grower with an EBIT growth of way more than 10% per year. I think since 2015 it was 46% per year, a high amount of investments and also no dividends. And according to this model, it's recommended to buy a stock and hold it as long as the growth is continuing. But please, as always, decide for yourself and don't rely on my assessment here or the ones from the institutional investors. For me personally, Alibaba already makes about 10% of my single stock portfolio. So that portfolio, I think, is about 25% of my overall portfolio. But yeah, that means that I won't buy more than a few stocks right now, maybe one or two, but that's it. But I will definitely hold it for the next years as I'm already invested. Now, my question to you is, are you already invested and what do you think about Alibaba? Let me know down in the comments below. As always, if you like this video and my research, then please leave a like and think about a subscription if you're not already subscribed. In the analytics, I see that 90% of my viewers are not subscribed to my channel yet, so this is your opportunity right now. It is my promise that I will always share my neutral opinion and I will not share any kind of hyped analysis here with you that is unrealistic, and I'll constantly try to improve the quality of my research and my videos. So that's it. Thanks for watching. I'm out.